All right, all right, all right. Welcome, welcome. We're going to come in here and today we're going to put on a bull call spread with a naked leg. I'm going to teach you how to do that. It's a wonderful strategy. I love it. It's one of my favorites. And so we're going to very simply drop one of these onto Procter and Gamble, and you can follow through with me and see how this is done and why. We'll talk about the pros and the cons. We'll talk about the good and the bad. All right. The worst case scenario as well as the best case scenario. So here we go. Let's come through, and the first thing we want to do is just identify the fact that Procter and Gamble is a good stock to do this on. First of all, it's got good dividends, so if you get assigned the shares, because if you sell a naked leg, there's a chance that you could get assigned the shares, and then you would own Procter and Gamble, which would not be a bad thing because it's a good stock to own anyway. Good, solid company, and they pay dividends, and we like dividends. So we're going to come in here. The chances of us getting assigned those shares is pretty low, but that is one of the downsides, and it's not even really a downside. You just might end up buying some shares of Procter and Gamble at a very low price. That's not a bad thing. All right. So the first thing we're going to do with this bull call spread with a naked leg is we're going to put on the bull call spread side. So we're going to come in here, and the bull call spread just means that all we're going to do is choose the time frame or the amount of time that we think it's going to take for the option to come to fruition, right? But we want to be in a market that we anticipate a rise in price. This is a bullish strategy. So what we want to do is we want to look at Procter and Gamble. The first thing I'm noticing here is that market's been going sideways. And then it had a breakout. It rallied up nice. So that's drive one. We're going to get a little counter trend in here. All right. So that's coming across there with a nice little, it looks like a little triangle formation, right? A little wedge pattern. And then we're going to anticipate a break of the wedge, break of those blue lights up in there. You can see that the market has come back down to the bottom of the Bollinger Bands, and we're anticipating a rise in price once again. This is called an ABCD pattern. So we can lay that out there with our Fibonacci ruler. And you can see that that projects out into the future where we anticipate this market being if it stays on that same volatility scale, basically. All right. So we're going to give ourselves a little bit more time than that. We're going to buy a little bit more time than what it looks like we might need, but that's the way I like to do it. I have a little bit of buffer in there. So we're going to come in here and we're going to buy a 45-day option. So that looks like the right one. You can see in Track and Trade, it's dark. That means that's going to be the one with the most volume and open interest on it. It's a quarterly expiration. So we're going to click on that one. We're going to come down to the options chain, and you can see the options chain down here has plenty of volume, plenty of open interest. The open interest is over 3,000. I like to have a little bit more volume, but we're early first thing in the morning, so it might be a little bit lower volume. The spread is what I'm mostly concerned about. The spread is not the greatest. It's $15, but it's something we can deal with here in Procter & Gamble. So we're going to go ahead and I'm going to buy the call. Let's clear out all these drawing tools, make it easy for us to see, all right? So we're going to come in here and delete those, and then we're going to buy our call, and we're just going to drop that on the screen, and we got two choices. You can see where that triangle wedge is coming into where we drew that triangle wedge, right? So the triangle comes in like this, and then it comes back like that. So we have basically this little triangle formation. So we want to kind of look on both sides of the triangle, and that's what we're looking for. So we could buy the call above the triangle, or we could buy the call below the triangle. We can't put it right on the money because there's not a strike price there. So it's just a little bit above or a little bit below. Now there's advantages and disadvantages to each, and I'm not going to go into the disadvantages and advantages of buying one versus the others. Just this one's a little bit more expensive, so you're going to have a higher break-even point, right? This one's a little bit less expensive, and you're going to have a lower break-even point, but the market's going to have to move a little bit, tiny little bit farther with a lower delta to get profitable. But that's okay. We're going to go in with the lower cost, the one that's above the market. So we're going to drop this in here. We're going to pay $400 for that. That cost is going to come out of our account. We're going to pay $400 for that long call. It's very simple. That's the buy side of the bull call spread. Now we're going to just tell the market, hey, where do you want to take your profits? Where do you think this market's going to go up to? And where do we want to put our profits? It's like putting a limit order out there when you get into a market. You get in with a market order. You want to put a limit order to tell where the profits are going to be taken. That's all we're going to do. So we're going to just say, all we're going to do is we're going to sell this call up here. All right. So that's our profit potential. Now, to put that limit order up there, all that's really doing is saying we want to buy the call here and we want to sell it up there. That's our order. All right. But to do that, they're going to give us $206. So we're going to drop that in there. Now we could go a little bit higher, but that's up there. That they're only going to give us $93. And we really do want the market to go above that red line. So the chances of it going up above that red line, not so good. We like the the better chance, the better probability of the market going above this red line. So we're going to go ahead and do that. And we get more money for it too. It's $208. So we're going to go ahead and click into that. And now we got those two orders on the screen. You can see we're going to buy here and we're going to sell here. That's all we're doing with a bull call spread. We're just pointing out that we're going to buy here and we're going to sell here. Now, the difference between those two is $495, roughly $500. So if the call option goes up and goes above that red line and hits that purple line, that's the game we're playing here. It's got to hit that purple line above the red line. If it does that, we'll have max profit. We'll have $502 on our long call. We'll also collect the $206 on our red option the call option that we sold. So that would be that'd be $700. That's max profit, $700. That's really nice trade. That would be happening within 45 days on Procter & Gamble. And our only total outlay on this, because we get to receive 206 and we're going to pay 402, you can see down here the calculator, we only have to pay $195 for that option. And then we're going to have a $700 profit potential if the market breaks above that triangle and wedge formation and goes up and touches the purple line above the red line. That's it. Very simple process, right? Now we're going to put on the naked leg. Why do we put on a naked leg? This is such a good strategy right here. Why do we need to complicate it with a naked leg? Well, you're going to love this. Watch this. We're going to come in here. And what is a naked leg? Well, we're going to come in, and I'm going to actually put it on a separate ticket just so we can manage it separately. But you can see if we come in here now and we do this, we're going to pay $195. We're going to come in and we're going to mark it into this. I'm just going to mark it into it. You're going to want to bid for it, obviously, if you're in the real market. This is the demo account. I'm just demonstrating this. So we're going to go ahead and we're going to place the order. So we're going to come in here, and now we've got our bull call spread put on. Now let's put on the naked leg. Now you can do this on the same ticket, but I like to do it on a separate ticket just so I can manage them separately. All right, so we're going to come in here and we're going to sell a put. And we're going to sell a put right down here. Now, where do we want to sell this put? We can sell the put right under the market. How confident are we that this market's going to rise and not fall back down into its natural channel? Well, we're pretty confident that it's going to go up. Otherwise, we wouldn't be putting on a bull call spread. If we sell our naked leg right there, we would collect $312.50. And that would make this an entire thing. That would make this a profitable trade right there, right? I mean, we would end up with a credit to our account because we're only down $200 for the bull call spread. If we sell a put option right here for $300, we'd be up $100. That would pay for the spread, and we'd be up $100 if we have the confidence that the market is going to continue to rise. This would be a credit spread. Isn't that crazy? Now, the thing is to say, well, maybe if it does fall, I mean, there's always a chance it could fall back down to the channel. Maybe I don't want to take that risk of, having the market assign me my shares, which is what would happen. I would lose my bull call spread. I'd collect my premium, but I would be assigned the shares at that red line, which would be $170 a share. Now, I wouldn't feel bad about that. Owning Procter & Gamble at 170 would be a good deal. It's currently trading at 173. And we would be buying 100 shares at 170. But we don't have to do that. We could come down here and we could drop it clear down here. Now, we're going to collect $175 on this one. And if we collect $175 on this one, well, that's only about $25 away from the free trade. So this entire trade would only cost us $25 to put on. And if the market fell, let's drop that in there for a second. If the market came down, the worst case scenario would be if it touched that purple line underneath that red line, well, then we would have to own 100 shares of Procter & Gamble at that price, which would be $16,000. So the naked leg means that the covered leg is covered with cash. So we would be assigned 100 shares of Procter & Gamble, and we would take in this case, $25 loss. All right, so we're going to take our $25 loss, and we're going to be assigned 100 shares of Procter & Gamble. And that's putting on a bull call spread with a naked leg. That's pretty cool, right? If you like that strategy, then you're going to want to come in and subscribe to Pitt News Magazine. Pitt News Magazine is our magazine where you can listen to the articles, you can read the articles, you can actually even watch videos. And this is where we document all of this stuff, and we put in all of these different trading strategies that we talk about, and we have a monthly magazine. And a one full year is $39.95, but today with this coupon code, only 50% off. If you type 50% off when you go to checkout at pittnews.com, it's going to be only $19.97 for 12 issues for one full year. And this is a great little magazine. It's a multimedia magazine. You can listen to the articles, you can read them, and you can watch the videos. Don't forget to like and subscribe. If you love this video and you want more of this same type of thing, like and subscribe to the channel. We'd love to have you.